My favorite thing to do. I love talking with these three gentlemen right here. I love talking with Rick and Darren in particular, getting the data. And Eric has some killer insights for us. We hung out a little bit yesterday, so buckle up. Really grateful that you're all here. I mean, as you can tell, we're going to talk a little bit about the industry. We have some incredible data experts that are going to put some things out. But I think what's key is to remember data versus noise. And there is a lot of noise depending on what you track and look at. And so this year, though, we wanted to change the format a little bit. Darren and Rick are going to kind of go through some data points for you, share some updates on what they track and what we're seeing. And then we're going to be a bit more conversational. We would love, I mention this because we would love at any point in time, if you want clarity or have a specific question about any of the data points or any things that we discuss, please don't hesitate to jump up, scream, yell, do jumping jacks. We would love to incorporate. We just love to have a discussion about what we're seeing and what's happening. So with that, I'm going to give it to Rick and Darren. They're going to go in, and Eric and I will chime in here and there with extra questions and comments. So
make this a Tony Robbins event.
There you go. That's all you.
All right, Rick, how are we doing this? I'll start?
You start, looks like.
All right. Well, just to set the stage in terms of where we are, and the few panels I listened to today, a lot of folks were talking about increase in volumes in terms of the distressed market. And this is the way I look at the distressed market, and we at auction.com in general look at the distressed market kind of as a funnel or a waterfall, whatever you want to call this. At the bottom of the funnel there is where we live at auction.com, foreclosure auctions, properties brought to auction. At the top of the funnel are 30-day short-term delinquencies. And the dark green is the most recent quarter of data, which is right now the fourth quarter of 2025, based on the NBA data, even though we're into the second quarter of 2026, but that should be coming out actually I think next week, the new data. But and then to orient you, the light green is a year ago, and then the gray is kind of benchmarking us to Q1 2020, right before the pandemic hit. And so at the top of the funnel, you see that the dark green we're back to pre-pandemic levels, basically. In fact, we're a little bit over pre-pandemic levels, and we've been that way really for, I would say, 2 to 3 years, where that top of the funnel is filled up. There's these delinquencies. Now, a lot of those delinquencies have been cycling in and out and not really making it down the funnel very far. But over the last year and a half, we've seen that second stage start to fill up, and now that green, the dark green in the seriously delinquent bucket is above pre-pandemic levels as well, and has been roughly around that level or a little bit higher for the last, I would say, 18 months. Next stage down the funnel is foreclosure. The two next down the funnel are foreclosure inventory, foreclosure starts, and they're a little bit apples to oranges there, but I'll start with foreclosure starts, which is the second to the penultimate part of the funnel there. This was as the fourth quarter where it's 95% of pre-pandemic levels in terms of foreclosure starts. There is more recent data there that puts us actually above pre-pandemic levels if you look at the first quarter of 2026. So the delinquencies, the distress is starting to move down the funnel for different reasons that we can get into. Now the bottom of the funnel, the completed foreclosure auctions, we're still at about 55%. This is market-wide in terms of comparing to the pre-pandemic levels. When we look at our proprietary auction.com data, which is a little bit more up-to-date than the public record data, we're more like 60 to two-thirds of pre-pandemic levels. So there's definitely movement down the funnel. Those volumes are ticking up. But I think the good news for the housing market is this is certainly not doesn't appear to be a crash at this point or a wave of foreclosures. This is a return to normal and normalization back to levels that I think are more sustainable when it comes to the foreclosure market. So I'll stop there.
Yeah, and you notice that this chart, which I love, because it really shows exactly where we've been and where we are, doesn't go as far as REO inventory. And if we went to that next level REO inventory, you would see that the percentage of homes in REO today is even at a lower percentage than the lowest part of this funnel, where we're at 55 or 60% of pre-pandemic levels. in terms of the numbers of property brought to auction,
Sorry.
the number of properties going back to lenders as REO assets is probably still only at about 30 or 40% of where we were prior to the pandemic. And if you go back as far as 2019, for those of you that remember prior to COVID, there was a different world. It wasn't a big year for REO even back then. But we're nowhere near back to where we've been. Sam and I were talking about this a little bit right before we came out. And the reality is a lot of the folks that are delinquent or that go into foreclosure today still have equity. And Darren has 1,000 slides on what's going on with equity right now, which I don't think we're going to get into today. But the ones who do have equity are choosing to sell their properties prior to losing that equity at a foreclosure sale. So you have a lot of people opting out before that auction takes place, and there's still a fairly high sell-through rate at the auctions themselves. So not as many properties getting to auction, and the ones that get to auction in a lot of cases are sold before the lenders have a chance to take them back. And Eric, you can give us your inventory, and I think you probably have Fannie Mae's inventory memorized too in terms of REO assets and how they compare.
I will speak on behalf of Freddie, but yeah, I mean, going into the pandemic, we had about 4,100 assets, and so now we have about 2,300. So yeah, we're about 60% of what we were going into the pandemic. So, and granted, a lot of that was also predicated on the fact that we got down very low during the pandemic because the foreclosures were cut off. And the only thing that was coming to us were those homes that were vacant, and that was very few. And so, but at the same time, we kept selling everything that we had. So at one point, we got down to about 1,300 assets. But but again, we're at about 2,300, and we've been there for about almost 3 years now, relatively flat year over year.
And last time I talked to you, you were projecting this year was going to be flat again.
Yes, and actually because of some new strategies that we've implemented, we might even dip down a little bit further. So,
and if Fannie were here, they would tell you that trajectory is about the same.
Yeah.
I think, what was the last number were they around?
I think they were close to like double our inventory.
Yeah, I was going to say 4,000 or 5,000.
Yeah.
So
I think they were around 4,000.
But again, similar percentage to where they were prior to COVID.
Yeah.
And I think we're going to get at a little bit of the size, but it'd be helpful to kind of understand these off ramps as we look at the waterfall. Why things aren't sequentially growing as we further. I mean, some of our wisdom would say, well, things are growing at the top. That means the distress is hitting, but we're seeing these off ramps. So I think we're going to cover it a little bit, but just kind of tee it up.
Yeah, absolutely. Next, this is your slide.
Well, this is
Rick.
actually ICE's slide. I just borrowed it. Most of what we're seeing in terms of serious delinquencies are FHA loans. FHA loans, if you look at loans that are 90 days delinquent or in foreclosure, FHA loans account for about 50% of those, even though they account for about 13% of all active mortgages. So hugely disproportionate share of these loans are FHA loans. That also has some implications for REO inventory because, as you all know, if a property from the FHA isn't sold at the foreclosure sale, the FHA mandates that property then be assigned to one of the online auction companies, like auction.com, or a second chance sale, a CWCOT sale. Usually goes through multiple auction cycles before it gets conveyed back to HUD. So it takes longer for these properties to actually become REOs if they ever do get that far. But Fannie and Freddie delinquency rates are as low as they've ever been historically. You're looking at probably 2% delinquency rates overall. And if you want a predictor of mortgage delinquency rates, what I always look at is the unemployment rate. If you went back to end of fourth quarter that Darren was quoting from the MBA numbers, the end of the fourth quarter, the overall mortgage delinquency rate was about 4.28%. The unemployment rate at that time was 4.3%. So you can't get a much stronger correlation than that. So as you look at unemployment over the course of the year, that'll give you a gauge on mortgage delinquencies. And that number of mortgage delinquencies actually plugs right into Darren's waterfall from there. But this is the trouble area, and we'll get into a little bit more detail on how problematic maybe some of this FHA pool is.
You want to go deeper into that here, or do you?
Why don't we go deeper into that here? That's a nice segue. I'm of the opinion there may be a bit of a perfect storm brewing for the FHA loan portfolio. What you're looking at, 3 maps here. So we've talked about FHA loans being more seriously delinquent. About 12% of all FHA loans are in some stage of delinquency. That's about, give or take, it's about 875,000 loans. If you look at where there's a high concentration of FHA loans, it runs across the southern border of the country for the most part. So you start in Las Vegas and Phoenix and kind of go right along the southern part of the country. About 20% of all loans in Oklahoma are FHA. About 10% of all FHA loans are in Florida. Another 10% are in Texas. So you look at those states, and that shows you where you have the highest incidence of FHA loans. I'm showing you that because I believe that's where we're going to see most of the foreclosure activity in the next 12 to 18 months from the FHA book of business. The middle map is the change in home prices and home values since the market peaked back in 2022. And if you look at where property values are declining, it's the same states. It's Texas, it's Florida, it's Louisiana, it's markets like Phoenix and Las Vegas. There are a few outliers. Denver is one of those, and Colorado has a high number of FHA loans as well. But that suggests there might be some problems for those borrowers who took out a loan with a 3.5% down payment, and property values are down 20% in the last 3 years. They're effectively underwater on their mortgages. And then the map on the far end is where homeowners insurance premiums have risen the most. And guess what? It's basically the same states. Florida has the highest median homeowner insurance premiums. There are people in the Gulf Coast, whatever you call the Gulf these days, the Gulf Coast, who are actually paying more in their escrow principal and interest monthly payments than they are for more for their insurance and taxes than they are principal and interest. So it's a situation we never really anticipated, but if you're looking at that FHA borrower cohort, again, highest incidence in the states where property values are going down and where that cost of maintaining a property has gone up.
What I will say, that while this is FHA and our delinquencies are much lower, and while our inventory has stayed the same, the one thing I will say that we are mirroring is our inventory is shifting, and our inventory is shifting a lot to look like this. So our inventory had been very concentrated in the Midwest and the Northeast, and what we've seen over the last, especially over the last year, 18 months, is how it has shifted along that southern border. So for example, Florida and California popped back into our top 10. They hadn't been in our top 10 in years, and they're now back in our top 10. Illinois had been our number 1 volume state. Texas overtook that last summer and has really, pulled ahead by quite a bit. Just to give you an example, Texas has about 300 assets, where Illinois now has about 178. So it really overtook Illinois. So even though our delinquencies are much lower and we don't have a lot of REO, where we do have it is all now shifting into those same areas.
Yeah, and I think that's partly a function of, and I might, if you don't mind if I skip ahead real quick, this is the one this is our inventory for auction.com specifically, which should be very much directionally what the whole market is doing. On the left-hand side, we have the year-over-year increase in completed foreclosure auctions. And there's 45 states where those are going up year over year, so it's pretty widespread, although I do notice that Illinois is one of the few states where we have that down. But then on the right-hand side, you have each state relative to its Q1 2020 level, the benchmark of pre-pandemic. And so that's, I think, a little more nuanced and maybe more accurate picture. There's 18 states that are now above pre-pandemic levels, and when it comes to completed foreclosure auctions, Texas is one of those. In the green, basically all the states in the green there are above their pre-pandemic levels. So yeah, and you're seeing it's that pattern. But I was going to say, to Eric's point too, in those southern states, on top of the more foreclosure volume, you have lower sales rates at the foreclosure auction because those homeowners, those markets are struggling buyers are less willing to buy at auction because because home prices are going down possibly in their markets, and these homes have less equity, and so that's compounding this effect as well.
And then in terms of REO inventory coming to market, you see Louisiana there, where the annual percentage change in foreclosure auction volumes is down by 11%. It's, on average, it's taking 3,000 days to do a foreclosure in Louisiana. Still over 2,000 days in New York. So one of the reasons it takes so long for REO inventory to come to market is because it takes so long to get through the foreclosure process in some of these states.
Yeah, New York is technically orange there, but it's 0% increase, and then some of those other states like New Jersey are down year over year.
Yeah, and the other FHA note to make, and I don't think we have to go back to the slide. No, okay. Go back one more if you're going to go back. If you look at student loan delinquencies, guess which states have the highest rate of student loan delinquencies? Same states, heavily concentrated in the South and Southeast. That becomes very relevant because now we've seen student loan delinquency rates skyrocket over the last year since the government started requiring payments and reporting on payments again. Little known side note about student loans is once you're 10 months delinquent, the government can start, if it's a government loan, the government can start garnishing wages. And the average wage garnishment, I'm told, is going to be about $700 or $800 a month, which is a big hit to a lot of folks' monthly budgets. So again, all of these things just kind of layer the risk.
And the
on top
FHA
of each
borrower
other.
is more likely to have a student loan.
Yep.
I don't know the exact figures, but there's more crossover there than other types of mortgage debt.
But the good news is there's only about 10 million student loan debt holders who are delinquent. 5.5 million are seriously delinquent. 4.4 million are only moderately delinquent, but kind of moving up the list. So this can be a problem. And to Darren's point, we're seeing higher delinquency rates among borrowers who do have student loan debt than borrowers who don't have student loan debt. And this is a situation that could start to have an impact on housing numbers and certainly on foreclosure inventory.
I have noticed in both the FHA reports as well as the FHFA reports, and Eric, I don't know if you're looking at this, but the biggest reason now for, the biggest, I think, increase and biggest reason for delinquency now is that excessive obligation piece, which is kind of a vague reason, but I think that's lumped in with these folks who have excessive obligations, including student loan debt that's creeping in, and you know, even there's a lot of talk that I'm hearing from buy now pay later loans that don't have a lot of visibility, and that's one of those excessive obligation pieces that's both on the FHA side as well as Fannie and Freddie side is the biggest driver of delinquencies right now.
You know, one of the 47 slides we're not sharing with you today shows consumer delinquencies and consumer debt, and we're at a record level of student loan debt, about $1.6 trillion, about a record level of auto loan debt at another $1.6 trillion, and credit card debt is not at an all-time record, but it's close. It's at about $1.3 trillion, and that's at a time when your average new credit card is issued with an interest rate of about 25 to 29%. If any of you have a department store card that you used last Christmas, check the fine print, make sure you go pay it off quickly, because those department store cards are now charging 35 to 39% interest rates, which used to be a number that would get you arrested for usury, or that you could get from my cousin Vinny Cappuccino on the docks of Philly. But now apparently it's the new normal. So consumers are struggling with a little bit of debt. And I've seen some numbers from Freddie's economics team that show that the delinquency rates are worse among renters than they are among homeowners. But we are starting to see a little bit of creep into that. And interestingly, the only type of consumer debt that's not seeing a huge jump in delinquency rates is mortgage debt so far.
Starting to creep up, though. Speaking of mortgage debt delinquencies, that's where, did you want to speak to this, Rick?
Yeah, Joe, we've kind of beat this up, but again, if you look at the areas in the country that have the highest non-current rates of loans, highest delinquency rates, generally speaking, it's the same states. So it's not that losing value in your house necessarily is going to put somebody into foreclosure. The point here is those FHA borrowers tend to have higher debt-to-income ratios, less equity, lower cash reserves. If they do find themselves in financial distress, they're going to have a harder time finding a way to wiggle out. So again, if I'm forecasting where I expect to see more default and foreclosure activity over the next 12 to 18 months, it's probably in those regions.
Good. We already covered that. Just in terms of where we're trending when we look at this through the auction.com perspective, which is hopefully helpful to everybody else here, but we're looking at that bottom of the funnel number that I talked about earlier, which, and I don't have this going back to pre-pandemic, but if it were, just to benchmark it, we had about 200,000 completed foreclosure auctions in 2019. So for the last full year before the pandemic hit. The blue line is the actual numbers, and it's quarterly numbers but annualized. So we can kind of benchmark back to that 200,000 number. We're trending right now toward about 90,000. We're at about 85,000 in 2025. We're trending toward 90,000 based on the latest quarterly data in 2026. Our forecast, and some of you may have seen this, but when we do what we call our long-range forecast, we create 3 scenarios, and there's the red scenario, yellow scenario, and green scenario, and hopefully those are somewhat intuitive. Green is the housing market keeps going gangbusters, doing super well. Interest rates stay low, unemployment rates stay low, delinquency rates stay low, home prices keep going up. Kind of your Pollyannish situation, which actually, we've been in for a couple of years. We're not trending toward that. We're trending toward the yellow scenario, which is more of what I would call a slow motion housing correction, where home prices kind of flatline, at least nationwide, go down in some areas. Delinquency rates are creeping up, which is what we're seeing. Home equity, because of that home price appreciation piece, home equity is flatlining as well, and even going down. So that's what we're trending toward. There is a red scenario that we're not seeing develop yet, but I think right now I would say the risk is toward the upside, to put it in economist talk, where there's not a lot of chance, I don't think, that we'll go back to that green scenario. It's more likely that if it doesn't stay on the yellow line, we'll be trending toward the red line if there's some additional shocks that we're not even anticipating or don't know about yet, or haven't fully developed yet. Any thoughts on this?
Yeah, the last panel was talking a little bit about a black swan event. I did not have war with Iran on my bingo card for 2026. I don't know about you guys. But what that's done to oil prices, what that's done to the bond markets in terms of yields, rising mortgage rates a little bit, not as much as you might have expected. But if those oil prices stay high, stay elevated, $110, $120 a barrel, that will result in economies slowing down, not just here, but globally. We're not going to escape that, so our economy would slow down a little bit as well, depending on how long this goes. If that happens, you could see a corresponding rise in unemployment rates. If that happens, you see more mortgage delinquencies, you'll see more foreclosure activity. So there are economic forces at play right now that, left unchecked, could cause us to move more toward that red scenario. I don't see a housing market scenario, to Darren's point, where we go to a lower number of foreclosures, and so I'm with you on that. But I think depending on how long this situation plays out, it could get worse than what some of the forecasts are.
And just to note that the forecast area is just 2026. I'm not going out beyond that right here. But even for 2026, the red scenario is about 105,000 completed foreclosure auctions, which is still about half of what we saw in 2019. And then this is the equity piece that it's a little hard to explain, but I think it's really important, at least from my view, in terms of understanding what types of loans we're dealing with here that are rolling to foreclosure. So when we look at our book of business, and this is from March specifically, and this isn't on the slide here, but 57% of the loans that went to auction in March were tied to 2021 plus vintages, and that's a shift. So we're seeing more of the properties going to foreclosure auction that were either bought recently or refied recently in the last 5 years or so. And the importance of that is that these homes have a lot less equity. You know, overall, you have $35 trillion in equity. It looks really good at the high level. But when you dig into these properties, that 84% there, that's loan to value ratio, that's about 22 points higher than the loan to value ratio for all other vintages. So that means a lot less equity. And they're rolling to foreclosure from scheduled foreclosure auction to completed at a much higher rate, at a 10-point higher rate, at about 30% rate as opposed to 20% rate. So that means more volume at foreclosure auction. But then on the flip side, on the right-hand side there, the sales rate is about 20 points lower for these recent vintage loans, and because I'm still digging into exactly all the reasons why, but the most obvious is that they just have less equity, and because of that, they are priced somewhat high. They're priced to that total debt number, and that is skewing the pricing at auction, which means fewer of them are selling. And so that means more going to REO, which is a couple of years ago, we were talking about extremely high sales rates at auctions, but that's come down a little bit because of this dynamic where more of these recent vintage loans are coming to auction. And one thing I don't have on these slides is another implication here is that what we call the price execution at auction it's not that much different. So, you know, our advice to clients is you should actually price these properties better to sell, these recent vintage properties, because your execution on them is only 4 points higher than the older vintage loans, if that makes sense. So you're losing 20 points in sales rate and you're only gaining 4 points in price execution. And then that ties into this slide, because if you look, there's a lot of pressure. This is FHA data, their own data. The red line are the conveyed REOs, and the number there is their loss severity rate, basically. And it's been spiking on those conveyed REOs because they're potentially sitting there for a long time. The green line is what we call the CWCOT auctions that are either sold at foreclosure auction or the second chance auction that Rick talked about. So there's more pressure on loss severity if it doesn't sell at foreclosure auction, and that is something to consider in this market, so that we're looking at it. And I think this push toward, or this pressure on loss severity is starting to change the calculus of how sellers are pricing at foreclosure auction, and we're starting to see price adjustments based on that. Pricing adjustments lower. And actually that's what this shows right here. And I'll get to the conversational point in a second, but I think this is my last slide. But this is actually data. So today is Super Tuesday, which is the first Tuesday of every month in Texas and Georgia. We see that's when all the foreclosure auctions take place. And so I pulled the data, the May data. The green bars here, the left side is Texas, right side is Georgia. The green bars are the pricing at foreclosure auction, and you see a big drop in Texas, a 10-point drop in pricing, and the pricing is average credit bid at the auction to the estimated after repair value of the home, and that dropped by 10 points in April because some of these sellers are realizing, hey, if I take this back as REO, I'm going to lose a lot more money. And so I don't have that on this chart, but we saw a corresponding jump in sales rate in April in Texas especially. The blue lines are the percent of properties that we think are well priced based on bidding behavior and that will likely sell. And we don't have the full pricing for the May data, but it looks similar for Texas. In Georgia, you saw about a 5-point drop in pricing in April, but I think we're going to see a bigger drop in May now. Because there's a higher percentage that are well priced in Georgia. So this is the mortgage, the servicers out there and the government agencies as well that are responding and actually listening to the market and saying, hey, we need to adjust our calculus of loss severity and pricing based on what's going on in the market.
Everybody okay?
And when they're thinking about this, the Fannies and the Freddies of the world, the servicers who are responsible for these properties, have to factor into the pricing what it's going to cost to repair these properties. There's some data from Verisk. I think Verisk is a sponsor here, aren't they?
I'll double check. I'm not 100% sure.
But Verisk puts out a quarterly repair and remodeling price index, and if you look at the cost to repair properties, they've gone up about 67% in the last 10 years. If you go back to 2013 when the index starts, they're up over 75%. So if you're an investor looking to buy one of these properties, you're looking at what it's going to cost you to fix it up. And because of that, we saw reports from Adam that fix and flip gross margins in the last quarter were down below 25%. And if you're a flipper, you're usually looking for 30% gross margin, not net margin. I'm sorry, net margin, not gross margin. And they weren't even getting that on the gross side. So a lot of this stuff factors in. You guys have changed your repair strategy.
Yeah,
this-
but that's
this your
what I was gonna
softball,
tell you.
Eric. Here you go.
Even if you're not repairing them, just the preservation and maintenance cost of the homes that we get can be exorbitant. I mean, it's nothing for us to get a home in that's worth $50,000 or $60,000 as is, and have to do $30,000 or $40,000 in P&M for trash out. I mean, because a lot of the homes that we get tend to be more rural now. They're on land, and for us to go in and do the preservation and maintenance can be extremely expensive. So whether we're repairing them or not, there's absolutely a lot of cost if we have to do eviction work. So the expenses in REO can absolutely add up very quickly.
But you were coming out of a period where a lot of the properties you took back, you were repairing.
Yeah,
It seems
so-
like that shifted.
Yeah, that did shift. So we were doing a repair all strategy for those homes that we didn't sell in our day one that got to retail. And because, our strategy was to repair everything to minimum financeable condition, and that was, when you do that, you have to do the same thing to every property to get it to that condition regardless of price. So again, we were basically subsidizing a lot of those repairs to get them to that condition. And so we were not recovering on a lot of those repairs. Again, we could have a home that was worth $80,000 and we'd spend $130,000 in repairs to get it to minimum financeable condition, because a lot of the repairs that we were doing were not adding value. They were things that you would expect to be in the home, because we were not doing a lot of the cosmetics, doing more of the mechanicals and things. And so we'd spend $130,000 on an $80,000 house, and at the end it'd be worth maybe 90 or 100. So we have, switched that strategy to now it's a repair none with exception. So we'll do repairs if there's a health and safety issue, as we always have. We will do repairs if there's a code violation or a mandate from a municipality or a township or city. And many times those things can double dip into health and safety. And then while we're not going to invest capital repair dollars to improve the collateral and increase the value, we certainly don't want it to deteriorate and decrease in value. So if we have to repair a roof, put a new roof on to keep it from deteriorating, we'll do that as well.
I should add, to Rick's point, yes, we do produce a quarterly report. We also just did a fuel cost white paper, if you're interested. We took a good hard look at it over the last 4 to 6 weeks. Please get with Matt or Johanna, and we'll get with that. This is a shameless Verisk plug of the moment, I guess. But we are watching that and seeing that in real time. You have to keep in mind the way we look at things, we're price reporters. However, when things like the fuel cost changes are so volatile, we do double check data in real time as opposed to waiting for the kind of the 30-day look back. So that is something, to Rick's point, with the Iran war, it's hard right now, and I'm sure you're seeing it in your guys' pocketbooks, to really prognosticate what that's going to do, over a long period of time versus a short period of time. So we do have that data as well. If you want to get with us, we'll help you out on that.
But your point about, the sooner in the process you can liquidate, the less the severity is. Absolutely.
So if we think, guys, about, so the topic of this was to avoid the noise. Let's recap, if we could. I mean, Rick, you touched on it, but recap the major data points that we continue to talk about and track that should be indicators to this group that they want to keep an eye on. And I'll tee up. I mean, the first one you talked about was unemployment rate, but for all of you, Darren as well, what should these guys be tracking the most? Keep an eye on.
Oh, am I?
Sorry.
I thought
You want to,
Darren. You're Darren.
No noise. What are the basic
I just assumed I had talked enough, so it was good.
Well, you and Rick,
Yeah.
you guys can all chime in. But
Yeah,
just
I
want
mean,
to recap.
these are some of the things I look at the top, even above the funnel. I started at the distressed market funnel, but recession probability based on the yield curve, manufacturing index, what manufacturers are thinking about the market. That's actually improved recently, but I think it's probably going to go down soon. Consumer sentiment has tanked, as you can kind of see with that chart. It's at the lowest level ever, according to this specific index from the University of Michigan. Unemployment rate, as Rick mentioned, has that red bar is the highest we've seen in the last 12 months. It's not super high, I mean, granted, but it is trending higher. Inflation is also just recently spiked, as you probably all know from going to the gas station. And then the overall SDQ rates on consumer debt, not just mortgages, is also at the highest level since 2013. And then the mortgage rates, for sure, is another factor I'm looking at as kind of driving what's going to even go into the top of that delinquency funnel that we looked at earlier.
Some Rick, any other color, any comment?
Yeah, I tend to look at employment numbers, at wage growth, at population. So if you're in a market where you're seeing population growth, wage growth, and job growth, probably going to be a pretty healthy housing market, both for owner occupants and for renters. If you're in a market where some of those are not true, job number, unemployment's going up or jobs are being reduced, things like that, you're working for Spirit Air, then probably you're going to see some fallout. But yeah, and the other thing to look at is housing trends in your market. Are prices going up or down? Are sales going up or down? Because that has an impact on ultimately what we see in this part of the market as well.
Okay, guys, now's your chance. Questions or comments or clarifications? Got a few minutes left. Anybody at all? Don't be too depressed. This is the world we live in. We got this. Don't give up. No? Not a single person. Good job, guys. You did really well.
They're just waiting. They're waiting for the vacation drawing. Come on, let's be honest.
That's true. Sorry, Eric. It's going to be all you. Nothing at all.
You got to give it some awkward silence, Sam.
I do. Sorry. I'm a sales guy. I
Oh,
like
we
to
already
talk.
talked about that. I mean, I've got lots of stuff here. But
Yeah, don't. We have 7 hours of slides here in the back.
Okay.
Oh, shoot. Yell loud.
HUD changed the rules and the guidelines in the CAFMB, and you must bid it, or you cannot go down the second path and expect to get your FHA insurance claim. Did you hear that?
Yeah, you're talking about the
Yeah.
CAFMB bidding.
Yeah. So I'm curious what you are seeing for those that are not bidding the CAFMB, like especially if they got to come to the foreclosure sale with a check, and we don't want to do that. But do you see a lot of them completely bypassing the FHA insurance and saying, I'm not going to convey, I'm going to keep going down the auction path with auction or take it to REO? I'm just curious what you're seeing.
It's a mix, and so that number we thought was going to be, first of all, to start, with the number that at the top, which is the percent where that CAFMB is actually higher than total debt, where that's an issue. We thought it was going to be higher. We started out around 35%, but that actually has been going down steadily, and it's more like at 20 to 25% now. And with the HUD repricing, which is a big reason you saw the lower pricing in Texas and Georgia this month, that's becoming less of an issue. But I would say it's a mix, to answer your question, it's a mix of clients who say, yes, we don't want to deal with the mess of trying to bid over total debt. And so we're going to go with CAFMB. And one of the clarifications we actually got from HUD last week was that it's the winning bid that matters, it's not the credit bid. So even if they bid and I know this is getting into the weeds with auction, but You asked. If they bid the credit bid and it's below CFMV, but then the winning bid ends up above, which we believe in a good auction environment, it could potentially go up above CFMV. That then still, it's kind of irrelevant, I guess, at that point. But that's the number that matters in terms of qualifying for CWCOT. And I'm throwing out a lot of. Does that answer the question? I can't give you the exact percentages, but I would say probably more clients are going the way of we're not going to deal with the, at least of our clients, or not. We're not going to deal with the inconvenience of bidding and bringing money to the auction above of total debt.
Two other quick side notes on FHA, since I'm picking on them, and I love FHA actually, so this is painful to talk about. You see the jump here in delinquent loans in the FHA pool, and you're likely to read some comments from people who will tell you that it's a false number, because the reason it's higher now is because they changed the. Can you go back to that one?
Oh, I was just. This is the people who say it's a false number.
Okay, you can go there then.
Yeah,
but there are people who will tell you it's a false number because when the FHA changed its loss MIT waterfall back in October, part of the change was you now have to be in a 3-month trial period. And while you're in that trial period to see if you can make your payments, you're still listed as delinquent. I would argue and caution you to think maybe a little differently, that maybe what we're seeing today is a more accurate reflection of real FHA delinquencies than what we've been seeing for the last couple of years. Darren famously referred to what was going on with the partial claims program at FHFA as the wash, rinse, spin, repeat cycle, where somebody would get delinquent, they'd do a partial claims, they were magically no longer delinquent until they missed a few more payments, and they do another partial claim, then they go delinquent, then they do another partial claim, all the while eating away at their equity. We're not seeing that anymore. So now what we're seeing is when you're delinquent, you're delinquent. You're going to get one bite at the apple to try and do a loan mod every 24 months. The other point I would make about the FHA delinquencies is this will not overnight lead to a higher number of foreclosures or a higher number of REOs. The servicers I've spoken with basically say they don't expect the numbers in terms of default activity to materially change until the fourth quarter of this year. Because when somebody goes delinquent, it's going to take them a 3-month trial period. If they fail in the trial period, then you give them their foreclosure notice, and that kind of starts the clock ticking. We're already in May, so if you're going delinquent now, you're not going to really be in foreclosure until the last quarter of this year. So the expectation from the servicers I've spoken with, who were at the National Association of Default Professionals Summit, was that we'll start to see the numbers increase Q4 this year and throughout 2027, because it just takes that long to go through the process.
It kind of spurs a thought, guys, because I know when we talked last fall, and correct me if I'm wrong here, the biggest thing is like those ripcords have been pulled from last year. We have student loan delinquencies, we've got the loan mods that have gone away. So those ripcords are gone now. That's different than our talk track a year ago. We still had those things in place. This is really, that's it. Like we can kind of track this data through the year and see where it's going. Am I reading that right? Or okay.
Yeah, I think that's right. I think it's the drivers of distress are just an underlying economic issue, but then there's home equity, which was a cushion against distress. That's going away. And then on top of that, you have government policy, that piece of it, which is also loss mitigation policy, that was holding back some foreclosures, and that's gone away as well.